We've asked and answered two of the three major questions of economics. How will the economy produce goods and services? By its participants determining what kind of factors of production it has and how they will organize them. What will the economy produce? By considering what goods and services it has a comparative advantage in, and what production choices will meet the balance of current consumption and investment in economic growth that participants desire. Now, one question remains to be answered. For whom will the economy produce? Or asked another way, who will get the goods and services the economy produces? Most economies answer this question with markets, places where buyers and sellers of goods and services are brought together. And we're going to start building one of the most classic market models in economics, basic demand and supply. In order to better model what happens in a market, we have to make some simplifying assumptions. First, let's imagine a market where only identical copies of a specific good can be sold. For simplicity, let's say that it's a commodity like corn. All the corn being sold in this market is, for our purposes, identical in quality. Now let's first examine the buyer side of that market. This is typically called the demand side, and ultimately we want to understand what the quantity demanded of a good or service, in this case corn, will be based on another variable changing. Remember chapter 1, where we discussed dependent versus independent variables? The difference between the two is really important to understanding how we model markets. Dependent variables depend upon changes in independent variables. In the current example, the quantity of corn demanded is dependent. It's a dependent variable dependent upon changes in the independent variable in the model, which in this case is the price. This brings up another assumption of our model that might be hard to contend with, that price determines the quantity demanded rather than the reverse. Some of us were raised or perhaps taught to think of markets as places where the amount of demand for something determines its price. That is kind of true for more complicated versions of this model that make more nuanced assumptions about competition in terms of how many buyers and sellers are in the market. But for the beginning stage of our simple model, we must assume that buyers and sellers in the market are effectively price takers. The implication of our model then is that the amount of corn demanded depends upon the price of the corn, which would seem to make sense based on empirical or real-life observations and data. But how does the price impact the quantity of corn demanded? To figure this out, we would need to construct a demand schedule, which is a table that more or less shows the answer to the question, would you buy X good or service at Y price? In other words, the demand schedule shows us how many people would demand corn at any given price point. For example, at $9 a pound, 10 people may enter the market to purchase a pound of corn. Maybe at $8 a pound, that goes up to 15 people. If the price somehow fell all the way to $4 a pound, maybe 35 people would buy. This exercise can go on forever, as you could theoretically ask about any price point between a penny and infinity, but hopefully you get the idea by now. The demand schedule is useful, but in economics we like graphs, and communicating quantitative or numerical information in a graph is almost always preferred. So we want to take this demand schedule table and graph it as a demand curve. The demand curve should connect the points where the values on the y-axis, which usually plots the range of possible values for the independent variable, in this case price, intersect with the values on the x-axis, which usually plots the range of possible values for the dependent variable, in this case quantity. When we look at a complete demand curve, it should give us a pretty accurate idea of what quantity of goods and services specifically for us corn would be demanded in the entire market based on the price that prevails in the market. This should hold true even for values the demand schedule didn't explicitly ask about, because we can imply what those values are based on the slope of the demand curve. Now, one of the most noticeable features of the demand curve is its downward slope. This is a visual representation of something we call the law of demand, which says that in most markets, the lower the price of a good, the higher its demand, and vice versa. The curve slopes down because lower prices almost always induce more people to purchase a good or service. This isn't always true, but it is for our simple model. The law of demand holding true means that if the price increases, we should expect our position along the demand curve to change, or the quantity demanded should change, and more specifically decrease. It's very important that we differentiate this change in quantity demanded from a shift in the demand curve. A change in price in the market, the independent variable, will cause a change in the quantity demanded, the dependent variable. But changing fundamental traits about our dependent variable, quantity demanded, will change or shift the demand curve entirely. What kind of fundamental traits? Well, if people's preferences for corn change, it would shift the demand curve in a way that would change how much corn is demanded, regardless of the price of it. Same thing could be said if corn buyers' expectations for the future change due to climate change. Changes to the demographics of the population could matter too. For example, if the average age of the population increased and fewer Americans used corn or corn derived products as they age. Or if the price of things we call complements, goods or services used together, change, it may change demand for the good or service being modeled. In our case, you might imagine more people would buy corn if the price of beans, a common staple eaten alongside of it, or the price of a movie ticket declines. Remember, corn is used to make popcorn, which American movie theaters are known for selling as snacks for viewers. Likewise, if the price of changes for substitute goods or services, in our case, sweeteners derived from sugarcane can substitute for corn syrup, or wheat-based porridge could substitute for cornmeal porridge, then the demand for the good or service being modeled would change. When a substitute gets cheaper, we should expect demand for the good or service being substituted to decrease. Similar to complements and substitutes, income changes can have a varied impact on shifting or changing the demand curve, depending on the type of good or service being modeled. A normal goods demand increases as the incomes of the population increases, ceteris paribus, all else held constant, including price. And inferior goods demand decreases as income increases, assuming there is a better quality good that could substitute for the one being modeled. Think of canned corn versus corn on the cob. We can reasonably assume that if for no other reason than the potential health consequences posed by the inner linings of most cans, that as incomes increase in the neighborhood, you could expect fewer people to purchase canned corn. At the same time, they will likely replace the canned corn with fresh corn on the cob, and therefore you would expect that the demand for corn on the cob would increase. All of these changes or shifts would be regardless of the price. So if incomes increase, we should expect the demand curve for corn on the cob to shift to the right, indicating that at every price point more people demanded corn on the cob than previously. Concurrently, we should see the separate demand curve for canned corn shift to the left, indicating that at every price point fewer people demand corn from the can. Kept all that straight? If not, don't fret. You'll have a chance to go over most of it all again, this time on the flip side with the supply side of the model. We'll cover that next.